Good afternoon. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments from Monday, September 15th, 2025. Well, it's not exactly what the bulls wanted. Corn and beans did not hold on to Friday's really good performances. These corn finished the day down 6 3/4 cents at 423 and a quarter, traded as high as 428 and a half. We could not get past Friday's high at 430 and a quarter. I'll be honest with you. I thought we'd go fill that gap from the July 4th. We missed it by 2.5 cents. Hopefully, we get a turnaround Tuesday, maybe get another push higher. November soybeans down 3.5 cents, 10.42 3/4, traded as high as 51 and a quarter. Again, this market, that's why we keep our hedges on until it kind of works through the numbers. Lots of times it'll take a day or two for the market to really decide what it thinks of that data dump. Now, there was nothing bullish in that data dump. I hate to tell everybody that. Everybody knows that. Everybody's, got their own opinions about the USDA. I started in this business in 1990, and I've never heard a nice thing about the USDA the whole time I've been trading grains. It's just an adversarial relationship between producers and the USDA. And rather than stew about it, I learned a long time ago, the only thing that matters is the price at the end of the day. It doesn't matter what any analyst says or even I fell into the trap when I was younger where I always want to know what the big traders think. It doesn't really matter. The market's going to do what it wants to do, and you have to manage your own risk. You have to manage your own emotions, your own biases. You may hate the USDA, you may not believe anything they have to say. But at the end of the day, we have to deal with these prices, and like a lot of things in life, sometimes it's not fair. So we'll see. We definitely have to go focus our attention now on exports. No matter how you cut it, there's a big crop coming in corn, and I think that's what the market's dealing with. Wheat did manage to finish up a little bit of the day. December wheat, Chicago finished up a penny and a half at 525. Kansas City finished mostly unchanged, down 0.75 at 514. Minneapolis finished unchanged. Again, wheat is just fighting for its life at these 5-year lows. The only thing that's going to pull wheat higher, in my opinion, is going to be a continued rally in corn. Outside markets are pretty quiet. I'm looking at the crude oil market is sitting right around $63. The stock market's relatively unchanged, sitting at 46,000, basically all-time highs in the stock market. This is September. When we head into October, everybody's going to start fretting about, October. Lots of times we get some corrections in October. We'll see what happens. We are all waiting to see if the Fed will do just a quarter point or possibly a half a point after the kind of the negative numbers we got, especially with the unemployment numbers being adjusted last week. I think that surprised a lot of people. So we'll see. Is it going to be a quarter point? Is it going to be half a point? I think the Fed will cut it. I think what would be amazingly surprising to the market is if the Fed chairman said, "No, sir, we're going to sit tight." I think that would be the most surprising outcome. So, and again, when that happens, it filters through all the rest of the markets. We'll see how that trades. Finishing out with the protein complex, you just can't keep a good cow down. We hit 1 month lows on Friday, kind of a terrible close. It looked like we were going to push lower, and lo and behold, we've finished the day. These corn up 435 at 236 and change, 236.275. October feeders finished the day up 870, and another almost a $10 trading range in feeders, 55 to 40, 48. It's just amazing the resiliency in this cattle. This cattle market, if it's taught anybody anything in the last 10 months, or certainly in the last 3 to 4 years, it's that if you're long cattle, your best hedge, if you want to defend against unexpected and sudden corrections, your best hedge is a put option, because a put gives you the floor. You do have to pay for it, but you only pay for it once. If you hedge with futures, you just keep sending in margin money every time it goes higher. And what you're doing is you're kind of shooting yourself in the foot. You're protecting prices, yes, but you're leaving all the gravy on the table, and you're adding to insult to injury. You're sending in margin money to do it. So I'm a big believer for producers. 95% of producers should be using put options, in my opinion, versus hedging the board with futures. And if you want to talk about that, give me a call, Chris Robinson, Robinson Ag Marketing. Finishing up with the hogs. April hogs finished up 20 cents. 93.30 was the high. We're dancing around there as well with making taking another shot at that 94 area. 93.77 would be a new contract high. And again, the same strategy goes for the hogs as well. If you're a hog producer and if you're long hogs, you really want to be using put options as opposed to selling futures. So we will see if we get a turnaround Tuesday. We'll see if this cattle market will ever have a correction that lasts more than a week or two and more than 20 bucks. I mean, we had a $22 break in feeders, and then in 2 days we've clawed back almost half. Just incredible volatility in the cattle and incredible strength. So that's it for Chris. For the rest of the afternoons, it's Chris Robinson, Robinson Ag Marketing. I will be posting my private client seminar tonight. We're going to dig into what do you do when the market does the opposite of what do you think it does? How do you manage those hedges? We've got hedges on. I'm going to dig in deep into what we're doing with them. Have a great rest of the day. This is Chris. Take care.